Zimbabwe cash crisis
worse. Talking about Venezuela once again.
Systemic important banks. They removed the one factor called monetary awareness. Hey there, hope all is well. Back at you today with some more RT News updates. And as you can tell from today's title, we're going to be talking about how negative interest rates are and will become the new norm in the days ahead. And more importantly, I want to focus on some comments from the financial head of research for the People's Bank of China and how he said that negative interest rates are and should be considered in the days ahead as we head more into a deflationary environment, i.e. referring to the recession that is looming and underway. And so before I dive into those articles, as always, I want to encourage you to tune in tonight for an RTD live talk at 9:30 p.m. Eastern Standard Time, where we talk about a variety of subject matters such as the one here, as well as everything else happening in the markets, as well as the crypto space. So tune in tonight at 9:30 Eastern Standard Time, and we'll take time to talk about what's on your mind. But more importantly, if you have not, I want you to visit me at steemit.com/RTD. Follow me there where I share articles throughout the day on matters such as this, as well as other things I'm not able to cover via video. And then also, if you're new to RTD altogether, I want to encourage you to visit the RTD University page, where I put together all my prior interviews dealing with monetary matters, central banking, financial matters, as well as the importance of holding sound money in an environment when it goes negative, because the threat on cash will be existent. So let's dive into today's articles. So as I mentioned, I have a couple articles I want to share with you, all dealing with the idea and the concept of monetary policy being negative these days. And so you can imagine 10, 15, 20 years ago, the idea of going negative to where it'll be a threat upon holding cash physically in the banks as being a problem would never have existed. But today it is very real, and it's going to get worse. And so when you have a central bank economist talking about the idea of a conventional tool and negative rates all in the same sentence, that lets me know that the next tool to be implemented out of this monetary toolkit from the Federal Reserve Bank in and of itself might end up being actual negative rates, and then the threat to have upon fixed income savers, depositors, as well as those in retirement when it comes to pensions and whatnot. So some of the articles I want to hint at will highlight some of those subject matters that is very important for you to be aware of. But more importantly, before I dive any further, if you're new to RTD, I want to encourage you to click the subscribe button as well as that notification tab there to be informed of future RTD updates, as well as live talks and things of that nature. You'll be notified immediately when they are uploaded and when we go live. And so basically what I want to do today is just scan through the surface of some of these articles here, give you an idea of what's going on, and at the very end, share my thoughts with you on how this negative interest rates is coming and it is something that you cannot avoid, and share my thoughts on why it's important to really beginning to think outside of the conventional mainstream narrative of saving and investing, which is what we've been taught and has worked well up until this point. But now we're entering into a new economy and a new day and age where that advice may not be as effective as it has been in the past. So let's dive into today's articles. So the very first article here is from Reuters, and it says global central banks can adopt negative rates as conventional tool, PBOC working paper. And so I'm going to thumb through this because there's a lot of great points worth mentioning here. And it says global central banks should adopt a deeply negative interest rate policy during a deflationary recession and use it as a conventional monetary tool to revitalize growth, a Chinese central bank official wrote in a working paper. It says because the natural rate of interest rates in advanced economies may stay low in the long run, central banks are likely to resort to negative rate policy more often in the future, Song Gongfeng, head of the Financial Research Bureau at the People's Bank of China, wrote in a central bank paper. He's quoted as saying, if banks are willing to expose retail depositors to negative interest rates, the effectiveness of negative interest rate policies will be greatly strengthened, and central banks should adopt deeply negative interest rates during a deflationary recession. So here we have the idea that if central bankers are willing to impose negative rates upon depositors and they accept it, it might be something that could become a more normal environment. So just the idea of depositors themselves, most people don't realize that once you put your money into a bank, it becomes property / an asset of the banking system of itself, and you are technically loaning them money. And in the environment we are now, actually having money in a bank, in a commercial bank, but yet typically they usually give you interest upon holding and borrowing your cash. But now with the idea of negative interest rates, they're going to charge you to hold your cash in their banks. And what he's saying is the fact that if it can be adopted and implemented and it become a norm, then it's something that can possibly work. It says while the PBOC hasn't resorted to negative interest rates, a period of ultra low rates has been the norm globally going back to a decade since the financial crisis sparked a deep worldwide recession. It says many central banks, including the Bank of Japan and ECB, adopted negative interest rates to combat deflation and low growth. Sun's comments marks the first time a policymaker from a major central bank has proposed that negative interest rates should be used as a conventional monetary tool to fight recession. So here we go again. The idea, if we're in an economic expansion, as a lot of central bankers may have you think, why would there be any talk or mention of a conventional monetary tool in the form of negative interest rates being talked about or even being mentioned if our economy was in a healthy state? So that lets me know that if a financial head is even talking about negative interest rates during a recession, that lets me know that there are some things behind the scenes and some things that are brewing that's in the process of being planned out, and it has to do with the idea of implementing negative rates on a global scale. And it's good to say that the Federal Reserve Bank, being the #1 central bank because we have the current reserve currency, it's good to say that if it's being mentioned here from the PBOC, that it's an option that the Federal Reserve has considered. And I'm also going to show you an article in which a lot of the financial heads for the Federal Reserve Bank in St. Louis says that it's possibly a good idea already. So if the interest rate passed to depositors makes it complete, the negative interest rate policy becomes very effective in boosting credit growth and inflation. Furthermore, central banks should promote digital currency to strengthen the effectiveness of negative interest rate policies, contending that it will eventually solve the problem of higher cost of holding paper currency compared with the cost of bank deposits. So here we have the idea that he's suggesting and hinting at the idea of allowing digital currencies to flourish in a negative environment could be good for the central banks because it allowed them to cut back costs on actually having to print cash and hold cash, because people, once they realize that holding cash in the bank costs them, they're not going to really continue to do things that has been considered the norm as far as them wanting to continue to utilize cash. Then that factors in the idea that inflation will increase and cash in and of itself will become somewhat of a burden on the people. And so having an option of digital currencies, of which I would imagine he's probably referring to a central bank cryptocurrency to usher out to the people in exchange for the paper, was probably what is going to be an option or is already in the making. And so keep in mind that this is the PBOC mentioning about what will happen during a possible next recession. And so eventually we're going to get into the idea how negative interest rates from the Fed is being viewed as a positive in some manner. So more information on this article, feel free to read for yourself. Next one here is from Bloomberg, and it says, no exit in sight for the world record holder in negative rates. So as mentioned in our prior article, there's a couple countries that have already gone negative and some of the consequences and side effects from that. So here it says, no exit in sight for the world record holder in negative interest rates. So it talks about Denmark's FX reserve data shows rate changes a long way off. And so give you an idea what's going on here. It talks about how Danes aren't likely to experience positive interest rates anytime soon, says the central bank in Copenhagen just clocked in a 12th consecutive month without currency market interventions, meaning interest rates changes aren't imminent. It says a long drought in currency intervention draws a thick line under the notion that the rate changes are a long way away from Denmark. So what's interesting here is this life below zero. Denmark's main rate is now minus 0.65%. So if we are in an economic expansion or economic recovery, as a lot of people would like to believe or say, why are they still in negative territory or even near zero? That's just because there is no way they can actually bring rates to what has been considered normal, 5-6%. So that means borrowing costs have to stay low. And so in order for it to stay low, that means people, savers, investors are going to get shafted. So this article here talks more about how just a zero rate environment, how it impacts that economy there, and it puts pressure on currencies as well as savers or whatnot, because inflation becomes a problem. So there's more information in this article. If you're interested, feel free to read for yourself.
It's the next recession.
Recession will be.
Will be a recession.
We're going to hit a recession.
The date of the next recession.
A U.S.-only recession typically lasts 8 to 10 months, but a lot of things about this particular one have not been typical. So
A crash is coming now, whether it's 6 months from now, 12 months, 36 months, no one knows.
I go to bed every night, I dream of another recession. If you know what to do, if you have the right plan to set up, you can make a lot of money from this.
Next one here is from Bloomberg as well, and it says economic records abound in the land of negative interest rates. So this one here talks about because they are negative, Typically, central banks always talk about employment being of importance, but over here, there's apparently more jobs than they can ever imagine, and they're still in negative territory. So that goes to show that the idea of the Federal Reserve needing to establish a lower employment rate and all these data figures that they're looking to use to determine the rate of interest as well as the health of the economy is bogus. So to give you an idea what's going on here, it says, after almost 6 years of negative interest rates, Denmark is making a habit of setting economic records. It says the latest is in employment. Never before have more people had jobs in Denmark than at the beginning of this year. According to the statistics agency in Copenhagen, it says 2.7 million people were employed in the country in January. That's 6,800 more than previous records with decades back to April 2008. So if everyone's working, the economy should be doing just fine to where there should be no need to be in negative. You would think, but I guess that's not the case. So here's just some more graphs, give you an idea of employment record here. There was a quite big of a dip in 2010, 2014, but yet apparently the job market is doing just fine there. So you'd imagine they can reestablish those rates if that was the case, but I don't think it will. So there's just more factors to the idea that central banking policy is failing and it's being exposed as a farce. Next article here is from the Independent, IE, and it says pension cut by negative rates and tax bills. And so this has to do with the idea of how negative interest rates really impact those that are savers, investors, as well as those that are on fixed income, i.e. pensions and whatnot. So here's an article based upon a question posed by a retiree in regards to his pension and how it's been impacted by negative rates. And so the very first paragraph here talks about how once he retired, he set up an account and it had about 90,000 euros in it. And so throughout time, negative interest rates in this country has impacted his savings tremendously. And so he asked a question as to what can he do to stave off some of the losses he's taken because of negative interest rates. So if you go through here, you'll find out some of the conventional information there. But just the idea that this gentleman here put aside a certain amount of money and was anticipating it growing and lasting for him throughout his retirement, and come to find out because of negative interest rates implemented from the central bank there that he is no longer going to receive what he's promised, and he's actually losing money because of the fact that now his financial institution is charging him money to hold his account. So if you want to find out more details about this, feel free to read for yourself. And the very last one here is a very interesting article here because it's from the Federal Reserve Bank of St. Louis. And just the title alone lets me know that the whole idea of negative interest rates is a part of the monetary toolkit that I've mentioned in prior news updates. But it's a paper written by two gentlemen who are employees of the Federal Reserve Bank. And it's good to say that if these two gentlemen put this information out there, then it's already been talked about by those in higher up positions. And so just the title alone says, looking for the positives in negative interest rates. It says, although the U.S. has never used negative interest rates, many other industrial nations have implemented them to spur their economies and to continue to use them. For example, Denmark, Japan, Hungary, Sweden, Switzerland, an entire euro area have implemented negative nominal interest rates. Here's a chart as to how those negative interest rates actually stack up against each other. All these countries here listed are below zero. And so it goes on to talk about conventional wisdom. It says conventional monetary theory always assumed that policy rate cannot go below zero because an individual would not pay, in theory, to lend out his or her own money. Instead, people would hoard cash to prevent nominal rates from falling below zero. Here's a couple of things I want to share that I highlighted. It says when the zero lower bound is reached, the situation is referred to by economists as a liquidity trap, the point at which further monetary injections do not stimulate the economy because people opt to hoard all cash available instead of investing or spending it when things go zero. It says, however, if there are costs for people or institutions to hoard cash, then it is possible for banks to charge depositors by offering a negative interest rate. It says, in other words, negative nominal interest rates are possible because there are costs to holding cash, especially for large corporations. So then it goes on to say that it's not so far-fetched after all. It says negative interest rates may seem ludicrous since why would an individual buy a government bond with a negative yield? But this is what a central bank would like you to think. It says the central bank's goal is to incentivize agents to shift investments away from government bonds to something more productive economically, thus stimulating the economy. So here we have the idea that negative interest rates is something that has been suggested by the PBOC, but also the idea that the Federal Reserve said is not that bad of an idea overall. And then how that last article wrapped up is saying that the whole idea of lending money to the government is in the form of buying bonds might not be ideal, but the whole goal is to keep the economy flowing. And so by going negative, what that will do is force depositors to have to spend their currency as opposed to holding it, because if it's depreciating and inflation is high, that means they're not going to want to hold on the paper for much longer. That means they're going to want to spend it. And that's how the central banking model might continue to buy itself a little bit of time if they go negative, which will force depositors to have to spend and want to spend, because the idea of holding cash will not be a good idea. Because eventually if people hold too much cash, then they're going to begin implementing cashless type of concepts, such as the idea of a digital currency or something of that nature, which will discourage people from wanting to hold cash, because that will then affect the banking sector. So just wanted to share with you some information from the news on the whole idea of negative interest rates being a part of the monetary toolkit in the days ahead. And it's interesting to see how a PBOC financial economist is the one that's willing to come out and to say how negative interest rates will be the new norm, and how it's something that they have considered and have already begun to position when that recession is officially announced and they are in need of figuring out a way to keep the banks liquid, as well as help the overall economy, as well as keep this mainstream narrative going. So just want to share with you what's happening in the news. I would love to hear your thoughts on this matter. Feel free to leave a comment down below. And more importantly, join me tonight at 9:30 Eastern Standard Time for an ITD Live Talk. Looking forward to having you join me then. Thanks.